Joining me now is Steven Ehrlich, Director of Research for Digital Assets. Steven, thanks for coming on again.
Great. Thanks, Brittany.
Of course, you offered this really stark warning for Forbes. Beware of Flatcoins, crypto's inflation-busting fad. But I think to really heed this message, we need to first take a step back and talk about stablecoins. So let's start from the beginning. What do we need to know about stablecoins?
Right. And I think that's a good place to start. Stablecoins have been around longer than most people realize. In fact, stablecoins actually started around 2014, so almost 10 years ago. And these were created, I guess, as a solution to an early problem that Bitcoin advocates found, which is that as much as Bitcoin achieved its purpose of being decentralized and sort of immune from government interference, it did not really meet the standard of what we consider to be for modern money, in the sense that although maybe it could serve as a unit of account, as a means of exchange, it did not have very high throughput, and its excessive volatility made it difficult to really be a store of value, even though its hard cap of 21 million units might help it appreciate over time. If you're going to be using it to buy goods and services, or if you're a company and you're looking to use Bitcoin as a way to sort of manage your treasury, you would not be able to withstand 10% swings, either up or down, when it comes to paying expenses. So for all those reasons, stablecoins were created, which essentially are blockchain-based tokens. They run on top of Ethereum and most of the other major competitive blockchains out there. So they move faster, and in many cases, they're pegged to the price of an underlying asset, typically the dollar. Now, stablecoins come in many shapes and sizes. They're not all the same. The most common ones today, such as Tether, and which is sometimes known by its acronym USDT, and USD Coin, which is frequently referred to as USDC, they are backed ostensibly one-to-one by either cash in deposit at a bank, or other what's known as cash equivalents, like U.S. Treasuries, short-term dated U.S. Treasuries. There are, especially in the case of Tether, some more esoteric assets, digital assets, and longer-term loans. But that's really what the backing is supposed to be. There are controversies, especially surrounding Tether, because it's yet to disclose the full extent of its banking relationships, and the fact that it is an international company has led to many questions, some of which we've investigated at Forbes to try to figure out exactly what is behind Tether, because Tether in particular has grown to be an $80 billion asset and the key liquidity provider to the $1.2 trillion crypto market. So if there were ever rumors that, or if there was ever evidence that Tether was not sufficiently backed, it could be calamitous for the crypto industry. But aside from those stablecoins, there is also something known as an algorithmically backed stablecoin, which typically utilizes some sort of endogenous token to sort of help maintain that price balance. The most famous, or I guess infamous, example of that is Terra USD, which was backed by its sister token Luna, which famously collapsed about a year ago, evaporating about $45 billion worth of value. And then there's also some more over collateralized crypto stablecoins, the most famous of which for that is DAI, which has a market cap of around $5 billion and has been around for about 8 or 9 years or so. So those are the different types of stable coins. But they did have one key problem that's very central to crypto users, which is why this new crop of entrepreneurs created something called a Flatcoin, which is supposed to be an inflation-protected stablecoin.
So when you think of the name of this token, you think it's stable, obviously, you think it's safe, but based on what you're saying, that's not really the case, correct?
Right, Brittany. So these stable coins, by the very name, are supposed to be ultra low risk and are in a sense supposed to be boring. But that has not always been the case. I mentioned in my previous answer the circumstances that surrounded the collapse of Terra USD. Tether, again, has been sort of shrouded in controversy basically since its inception. And then even USDC, USD Coin, which is issued here in the United States by Circle Internet Financial, based in Boston, and is also co-managed by Coinbase, the largest U.S. crypto exchange. That was seen as, in many cases, or by many people, as the safest stablecoin out there. But that actually took a bit of a reputational hit back in March because it was revealed that amidst the banking crises that we've spoken about before, in particular the collapse of Silicon Valley Bank, Circle actually had $3.3 billion in collateral in that bank. And it turns out that they were made whole, but in the couple of days it took for the FDIC, the Fed, and the OCC to determine or come to the agreement that they were going to guarantee all deposits, no matter how far in excess they were of the $250,000 limit that everyone kind of has seen on bank signs when they've gone into their bank. There was a problem there, and the price of USDC collapsed below 90 cents. I think it got down to as low as 88 cents to the dollar when investors of this token realized that there may be, I guess, a $3.2 billion shortfall in collateral underpinning what at that time was about a $40 billion token. So there were fears there, and for all of those reasons, even USDC had some issues.